versus an equity index account. What should I do when the market is down? Well, the first thing we recommend you do is take a look at your retirement portal. Go ahead and open it up and take a look at it if you can. A lot of times, employers will lock down the portal because the market has fallen and a lot of people are trying to get online. So it might be a little bit difficult to do that. But if you log in on a regular basis, during the times when the market is down, you won't have trouble. So the first thing you want to do is register with your employer, log onto your retirement portal, and take a look at what you have. The beginning of financial literacy is financial awareness. A lot of times you can look and learn a lot just by observing what's doing well, what's not doing well. The second thing I'm going to ask you to do is log on to something called Market Watch. All right. And right now, I am going to share my screen and we're going to have a look at a couple of places where you can observe what the stock market is doing. Okay. So right now, I am sharing my screen and hoping for the best. When you're live, boy, all you can do is hope for the best. Okay, so here we go. So what we're doing is we're taking a look at something called Market Watch. So if you type that into your phone, you will find that you can watch the market as it's going up and down live right on your phone. Okay. And I have this on Canva, y'all. And I'm really trying to figure it out. Okay. So let's see. Is it moving? Let's see. Yep, I had to upload it to Canva. Oh, yep, there it goes. Okay, so this is a screenshot that I took earlier today. It is the top three markets that you're going to find in your retirement plan. So the DGIA, that is the Dow Jones. So on the New York Stock Exchange, you'll notice that there are stickers and there are acronyms that are going across the ticker. So if you see DGIA, that is the Dow Jones. The second largest one, of course, all of them are pretty large, but it's the S&P 500. So that's the top 500 companies in America. So let me slide on back here because it's boogieing on down, and I want to back up a little bit and go just a little bit slower. Okay, so then you have the NASDAQ. So those are the three indexes that you'll find in most 401ks, 403bs, IRAs, and thrift savings plans. Now, the good news is that if you look at it today, you'll notice that it is up. So when it's green, that means that it's up. When it's red, that means that it's down. Really easy, right? So you can see today the Dow Jones is up 1.13%, which is here. The S&P 500 is up 0.99%. The NASDAQ is up 0.08%. You all with me on that? So those are the three that I just want you to concentrate on if you have a 401k. All right. So if we take a look here, I have started the video. So again, this is a screenshot that I just uploaded on Canva so that you can kind of get an idea of what to look for, what to Google, and then the steps you need to take. So here you can see it's just moving, right? You can see it, the clock is counting. And you can see that it dropped a little bit. Sometimes it'll go up a little bit. So this is live until 5 p.m. today. So if you want to go on there and follow along with me, I want to highly recommend that you do. The more you do it, the more hands-on you are, the more you learn. Yes? All right. So the point I want to make here is that the stock market crashed last week. So it crashed by 1,300 points in 3 days. And many financial professionals were predicting that there would be a recession. And then financial professionals started saying, no, we don't believe it's going to be a recession just yet. We believe that the market is going to take a turn. But in the interim, billions of dollars, billions of dollars were lost on the stock market. So much so that you saw um, Trump's buddy, what is his name? I can't even think of his name. Elon Musk selling Teslas on the White House lawn because he claimed to have lost over $30 billion. What does that mean for you and I? We are not multi-billionaires. That means that if you look inside of your retirement plan, you're going to see $50,000, $100,000 lost. And a lot of times that can be a year, 2 years, 3 years worth of hard work and income that have gone down the drain, right? So, how long would it take you to put back that money at a rate of 8% of your pay? Most people put in around 5% to 10% of their pay. It's a rare occasion where you see people putting in 15% of their pay. As a matter of fact, if you're putting in more than the matching, we want to ask you to pull back on that right now. Only put in the matching money because that's free money the company is giving you. Anything that's over the matching, you want to Roth it, which is tax free when you retire. So if you put it in the Roth account, when you pull it out at age 59 and a half, you don't have to pay any taxes. Very simple. If you pull it out before you're 59 and a half, you're going to have to pay a 10% early out tax penalty. So I don't know about you, but 10% is much less than 25% federal taxes and 5% state taxes. So no matter how you look at it, if you put your money in the Roth, you're going to be much better off. Capiche? Because you're going to save at least 25% on taxes. All right. So the whole point here was, Rochelle, the 401k versus an equity index account. What should I do? Well, I'm going to recommend that you do what every wealthy person in America knows to do. And what is that? I want to recommend that you put a floor on your retirement plan. Rochelle, what is a floor? Well, in the financial industry, you're going to hear the word floor. That simply means that when the market drops, where does it stop dropping? What is the floor, right? When does it stop and then take a turn? I want to recommend that you put a floor on your retirement account, which means that when the market drops, you don't lose a dime. Now, in an equity index account, your floor pays you 0 to 3%. So that means when all those jokers out there on the stock market are losing their money, you're still getting paid zero, which you're not getting paid at all, to 1 to 3% interest. So your equity index account has a what? A floor of at least 1%. Your money is always earning money, even when everybody else loses theirs. Okay, so let's take a look and see what that looks like. So if I go right back over to this graph that I was sharing with you, now I want to hide this flotation bar, okay? And I'm going to go back on Canva and I want to take a look at this graph, All right. And I want to slide past all of this. Now, I want you to look at this is a graph that you will find on Yahoo Finances. Write that down. Type it in your phone. So on Yahoo Finance, you'll see a live graph of what the S&P 500, the NASDAQ, the Dow Jones are doing. And again, those are the three that you want to concentrate on if you have a retirement plan. If you take a look here, I took a look at the 1 month returns on the S&P 500. So if you go, this means 1 day returns. This is 5 days. This is 1 month. This is 6 months, and this is 1 year or year to date. So you can click on each bar and you can see how it's done over the past 5 days, how it's done over the past month, how it's done over the past day. And if your money is out there, you want to take a look. If you scroll down, you will also see right down here, there's a summary, the NASDAQ, the S&P 500, the Russell 2005. Now, this bad boy right here, I want to highly recommend to you. This one is called the Mass Mutual Blue Chip. Write that down. See if your employer has this one, the Mass Mutual Blue Chip. Mass Mutual is a mutually owned life insurance company that's over 100 years old, and they're allowing you to participate in some of the company's gains. I have seen this bad boy sing and ring and do some beautiful things. So if you do have the opportunity, I want to recommend that one to you. So that was a free money making tip. I'm not charging you a dime for. So you also have the Russell 2000 here, and then and as you scroll along, you'll see all the very large indexes. The New York Stock Exchange composite, right? And then as you scroll down again, you'll see it all summed up again. The Dow Jones, the NASDAQ, the Russell, and the New York Stock Exchange deposit. And then you'll also see some videos. I want you to be careful of watching these videos. Just remember that everybody's getting paid from selling stocks on the stock market, and they get paid whether you lose your money or not. A lot of times they get paid more when you lose your money because they've got a hedge fund full of fat cats that are waiting to buy out those other companies. So they're getting paid on both sides of the fence. So, yes, listen to it, but listen to it with a grain of salt, always remembering that they're getting paid commissions and salaries and so on. Okay. So, this is what the stock exchange did last week. Notice that it was all in the red, and then it took this horrible, sharp dip, right? And if you go back and you scroll, you'll see 1 year, 6 months, 3 months, 5 days, and then 1 day. And then we took one of the most horrible dips where billions of dollars went down the drain, and Elon Musk started selling Teslas along with Donald Trump out on the White House front lawn, which I thought was the craziest thing I'd ever seen. But listen, so what was the first tip I gave you? I told you to always put a floor, right? That's tip number one. Always put a floor on your stocks, insurance on your stocks. Notice how well Mass Mutual did when everybody else was losing their pants. Why? Because they're a mutually owned life insurance company. So a large part of their profits are not on the market. It means that the policy holders are shareholders, and their policy holders have been shareholders for over 100 years. That's how they started their company. They said, well, if you buy a policy in exchange for doing that, we will offer you shares in the company. And those shares come in the form of dividends, right? So much, much safer when the stock market is going down to have shares in a life insurance company. Your stocks, a lot of time, are going up when the market's stocks are going down. That is a huge tip. So we always have our clients in some type of life insurance product, because the life insurance products are always, always, always going to be making money when the stock exchange goes down. So put a floor on your stocks, put a floor on your equities. Let's take a look at a 175-year-old mutually owned life insurance company. What does that mean, mutually owned? That means that they do not trade on the stock exchange at all, which means you can't buy shares in this life insurance company. The only way you can own shares is if you own a policy that pays you dividends. All right. So policy holders are shareholders. That's mutually owned. So it's much, much safer when the stock market crashes to have a policy or shit where you own shares in a life insurance company. So let's take a look at a mutually owned company, and let's take a look at one of my clients. So notice here, first of all, that you do get the indexing. Thereby, that's why it's called an equity index account, because you get to participate in market gains and take zero losses. So you hear the S&P 500, which you saw on the New York Stock Exchange, the global balance that consists of Japan, which does really good because it's a peaceful country, right? When there's wars in other countries, Japan does pretty good. Germany, and a part of the Russell 2000. So that's the global balance. Again, Japan, Germany, and a part of the Russell 2000. So that's a good, safe place. When the United States is going down, Japan and Germany are either holding stable or going up. Yes. So that's one of those indexes. The US fundamental, similar to the Russell 2000. So when you have 2000 companies, you have less volatility, or less what? What does volatility mean? Market risk. So you get to participate in these markets at 135%, 100%, 180, 185%, and 250%. What does that mean? That simply means if the US fundamental or the Russell 2000 does 10%, you will earn 25%, right? So you earn 250% of what the market does. But when the market crashes, your money will sit on the floor. And Rochelle, what is the floor? The floor is 0 to 1%. So when the market crashes, you will still earn 0 to 1%. So what does that look like in real dollars? I'm glad you asked. Here is a client of mine retiring from the federal government. He wrote over $810,000 out of his thrift savings plan. Well, while he was in the process of rolling it over, the market crashed. his account was almost at $1 million. But because the market crashed and his money is in money jail, there was nothing he can do. He even moved it to the G Fund, but the G Fund are government bonds. And when the stock market crashes, a lot of times government bonds will take a dip as well. Rochelle, what is a government bond? A bond is simply a loan. So let's just say you loaned my company money. Said, Rochelle, I'm going to loan you $50,000 to do whatever it is you need with your company. And in exchange for this $50,000, I expect a 5% return March 17th of next year. So I'd have to pay you back your $50,000 plus an extra what? $2,500, right? Next year. I have to pay you back the 50,000 plus 5% next year. If my company does not hit that 5% profit range, then guess what? You took a loss. I would owe you that 5% because my company didn't hit that profit margin. Are you picking up what I'm laying down? So when you say bond, it is simply a loan to the companies in exchange for a profit. So when you pay for government bonds, you're loaning money to the US government to do infrastructure or wars or whatever they're going to do. But if they don't hit those profit margins, your bonds will still decrease in value. So even though you have bonds and even though you have the G Fund, there is still no guarantee that you're not going to take losses. So yes, he did move his money to bonds or the G Fund, but he still took a loss. And the total loss was over $150,000. So by the time we were able to get this money out of his thrift savings plan, he was only able to roll over $810,000. Now, what does the life insurance company do when you do this? They pay you. They pay you a bonus. On this particular account, this gentleman earned a bonus of $81,000. So can you imagine? He opened up his what was the thrift savings plan after losing $150,000. And as soon as he opened up his portal, he saw, I'm just doing the math, y'all. Hold on. 810, 81. He saw that his balance was $891,000 instantly. The market was down. So, but he had a floor. So when the market was down, he still earned $2,049.31 on his money. So by the time it was all said and done, this gentleman had $893,049.31. Now I want you to take a look at this. In an equity index account, again, there is a floor, right? And in some of the indexes, the floor is zero. So you can see 6%, 6%, 9%, 7%. Here is where he got that second year bonus where he earned 225% of the market. So his account earned 20.59%. His account earned $245,000 that year. Then the market dropped again. His account still earned $7,000. And during bad economic times, like the one we're in, his account just held to zero. Zero was his hero. And instead of losing that $250,000 that he gained, his account just held tight at $1.4 million. So notice how fast he was able to recover his money because his money has what? A floor. So he earned 100,000, 400,000 because he got that what? Second year bonus. Boom, that 225%. And there he earned $450,000. Well, did he turn around the next year and lose it? No. The market dropped and he still earned 10,000. And then when the market took a bottoms out, he held tight at $2.5 million. So this is the difference of having a floor on your money so that when the market takes a dip, you don't lose a dime. But when the market goes up, you earn 100% of it, 185% of it, 200% of it, 250% of what the market earns as you take first and second year bonuses. So, my question to you is, which one do you feel is better for your retirement money? Going straight into the market and losing hundreds of thousands of dollars and still owing taxes after you take those losses, or having an equity index account and making sure your money has what? A floor. My name is Rochelle Dickerson, and if you would like to see this account for yourself, reach out to me at RhemaFinancialSolutions.net or shoot me an email at RhemaFinancialCoaching@gmail.com. We will take a look at which one of these accounts work best for you. Watch your money. You work hard to get that money. Don't just throw it out there and lose it. I love you and I'm here for you. Bye-bye.